Hey everybody, welcome back to another episode of A Millennial's Guide to Real Estate Investing. Today I have Michael Bishop. He works with a large syndicator, helping the syndicator fund their deals. They do large syndications all over the U.S. I actually DM'd him, asked him to come on the show a couple days ago. He gladly accepted, so thanks for coming on the show.
Oh, absolutely. Thanks for having me.
So tell everybody a little bit more about you, better than my rough introduction, and why and how real estate.
Yeah, absolutely. So I have a degree in economics and mathematics from Indiana University. Moved to Austin, Texas for work straight after graduating, and I took a job in IT at General Motors. Um, and my background and my interest have always really been in personal finance and investing and helping people grow their money and make smart investment decisions. And then when I got to Austin, I saw how hot the real estate market was, and I started to really get interested in real estate, but it was more on a personal level, right? So I kind of got interested in the same way that a lot of folks do, and that's, build a portfolio of single family homes type of thing. Quickly realized that I wasn't gonna be able to scale the way that I wanted to scale, or grow as fast as I wanted to grow. It just wasn't as big as I wanted it to be, right? Being young, the capital wasn't there. It was gonna be a lot more difficult to grow my own portfolio of single family homes. So at that point, I started networking and kind of meeting with anybody that would meet with me, learning every aspect of real estate that I possibly could. And that's when I came across the person who ended up being my mentor now. And he introduced me to the world of real estate syndication. And we'll talk a little bit more about what real estate syndication is, but it ended up being a perfect mix of personal finance and helping people grow their money, and using real estate as a vehicle to do that. So I jumped in right away, and I founded Bishop Investing Group shortly after meeting with my mentor. And he extended the offer to mentor me and bring me on in order for me to help him.
Yeah.
And so I founded my company shortly after that, and that was in September 2017. And I haven't looked back since, and it's been going great.
Awesome. And then how many deals did you guys syndicate last year, you and your mentor?
I was involved in 7 myself,
Awesome.
and he did. Don't mark my word, but I want to say 13 total.
Okay, awesome. Yeah, lots of volume. And then what is the average deal size or unit size for those kinds of deals that they're doing?
Yeah, so it varies a little bit because we do self-storage, mobile home parks, and the base of our deals are multifamily. So the unit size varies a little bit.
Yeah.
Typically with the multifamily, so apartment complexes, we're not looking at anything that's less than 150 units, and that's primarily because smaller units just don't support the syndication model. There's a lot of costs associated and things like that. So.
Yeah.
And then self-storage, several hundred. A lot of times we're looking at 1,000 units plus. And then mobile home parks we operate in funds there, and they vary a lot. So it can be anywhere from a 15 lot park to a 150 lot park, and it just really depends on the park and the market, really.
Got it. Okay, cool. And then so going back to your story and how you first started, when you were first starting, you said, doing the single family home, buying rental properties or buying turnkey rentals. Did you ever go down that path? Did you ever start just buying those rentals, or did you just look at the numbers and you're like, this is just not enough for me at the end of the day?
So I bought the house that I'm in now as a rental, right? And once I decided that wasn't going to be my path, I decided to just stay in that house, this house. So I actually didn't go that route. I just jumped right into syndication, and couldn't be happier with it. Yeah, nothing wrong with single family homes. Just necessarily wasn't fit with what I wanted to do and with my goals and my strengths.
Yep, absolutely. So. Okay, cool. And then you're still working full time, correct?
I am, yeah. I work full time at General Motors as an IT system admin, and a lot of people joke that they don't go hand in hand at all, because a lot of times system admin, you kind of bury your nose in a computer. You don't deal with people that often. You're not kind of a relationship manager type person. But there's 2 sides of me, really. So full time, I work Monday to Thursday over there, and then during the days, because I work evenings, and then during the days and Friday, Saturday, Sunday, I work on my business.
Awesome, cool. And then you also said that you did a lot of networking when you were first started. How did you go about networking? For me, I always pitched bigger pockets. When I started, and I read Rich Dad Poor Dad, and I was like, oh shit, I need to start meeting these people who are doing this, right? So how did you go about that? Were you on bigger pockets, or what did you use to network and to meet people in the industry?
Yeah, absolutely. So first of all, I'm still networking, always networking, right? Second of all, bigger pockets has probably been my biggest source of networking right now, just because, being full time, I don't quite have as much time to go out to a lot of those things. And working overnight, because my day job is kind of a 24/7 follow the sun type model. I work overnight, and a lot of networking events are at night. So bigger pockets has been a big one for me. I do get out to networking events whenever I can, really. And then referrals has probably been the third biggest source. So the small network that I started with has kind of expanded out to family and friends that they've referred to me. So those three things, and then I'm pretty much constantly on phones with people trying to help them understand this space and educate them on exactly what syndication is and how they can get involved.
Okay, so let's get into that. So what is syndication,
Yeah.
and how do people get involved? And yeah.
Yeah, so I'll start at a very high level, and you can ask questions
Sure.
just so that we can kind of dive in a little bit. So,
Yeah.
syndication at the very highest level is it doesn't only have to be real estate, right? It's basically a group of people coming together and bringing different skills or different resources, money, time, knowing how to underwrite, knowing how to source deals, whatever it is, and pooling all those resources and being able to accomplish something bigger that they wouldn't be able to accomplish on their own, right? So, if you think about it in terms of an apartment complex that, say, costs $25 million. There's not a ton of people out there who, one, have the money to do it. And if they do have the money to do it, they're probably not out there buying apartment complexes, right? So what happens in an apartment complex syndication is you have typically the guys who do the underwriting and the asset management and things like that, who really, really know that asset class and how to manage it and how to increase value to it and that type of thing, right? And then, of course, you have folks like myself who come and they help fund those deals. And then you have the construction management group, you have the property management group, you have the broker, you have a bunch of parties that come together to accomplish a goal that each one of those parties probably wouldn't be able to do by themselves.
Got it. Okay, cool. And then you guys split up just based on equity, right? So do you guys do the 70-30 kind of split, or how do you guys split it up with those investors that you bring on?
Yeah. So all of our deals also have a preferred return. And for those listening who don't know what a preferred return is, it's basically first guarantee at a return if it's there. So if we have 8% preferred, for example, if there's an 8% return on the overall property, that's all going to the limited partners, right? And then beyond that, typically how we're structured is a 7 to 8% preferred, and then a split in profits after that. And that's typically like 70-30 split is how most of our deals are structured.
Okay.
Varies a little bit depending on the asset class, the market, what the deal is. But yeah, that's we always like to give the preferred return to our investors to show, we're not making money unless you make some money.
Yeah, exactly. And they get the money first. So the first 8% return goes to the investors, and then after that, you guys get paid. So yeah, it gives them the incentive to, because every first dollar in profit goes to the investors. You guys don't even get to touch it.
Yep. Yeah, we don't get anything until all of our investors involved make 8%, and typically that's a pretty decent profit, because when you're looking at that size deal, and you're bringing anywhere from 5-10 million plus to the table in equity, that's quite a bit of money in earned returns.
Awesome. All right, cool. And then so for those, how are you guys finding all those deals? Sounds like you guys are doing a lot of deals. Where are those deals coming from? Is it through, just broker relationships? I bought an apartment building a couple of months ago, and it was just strictly based on a broker relationship, and now that broker sent me another deal. So broker relationships have been what I've been using to find deals. What are you guys using?
Yeah, absolutely. So just to clarify, and this is the beauty of syndication, I'm not actively out finding the deals. I'm helping fund the deals and source equity so that these deals can happen, right? But broker relations are probably the number one way to find deals, right? It all comes down to networking and building a team, just like pretty much any other type of real estate, right? So our sponsors, our GPs of our sponsor groups are out there constantly networking with brokers in the market and with other owners. They're always going to real estate meetups. They're going to big conferences. So they're pretty much just always getting out in the markets that they're interested in, so that they have the first look at a lot of deals. And another aspect of that as well is our sponsors are decently big players in the markets that they're at. So they're known in that market amongst the brokers and the lenders and everybody that they make deals happen. They don't just make offers and then end up backing out. So a lot of that is about reputation as well, on top of having the relationships, right? So,
agree. Okay, cool. And then one question just popped in my head: So somebody who's, let's say in your situation, works full time or maybe doesn't work full time but wants to do what you're doing, wants to work for a big mentor, a big syndicator, and help them with one aspect, whether it be raising the funds or finding the deals or underwriting, whatever. How did you go about finding the mentor that you had, and what would you recommend for somebody who's looking to be in your shoes?
So my situation was unique. I came across the right guy at the right time. He was looking to build a little team, put together a team so that we can tackle bigger deals together. And he saw that my interests were perfectly aligned with what he was doing, offered me the opportunity. I jumped on it. Now, for somebody who wasn't lucky and came across that opportunity, what I would recommend for somebody who wanted to get involved in the syndication space, no matter what the asset class is to first of all network with sponsors, right? So go on Bigger Pockets, read books, listen to podcasts, all those things. Find the sponsors that you're interested in.
And what's
right?
a sponsor?
Now, a sponsor is the group that is responsible for running the deal. So a sponsor comes to us, says, hey, we have this deal. Can you help us fund it? We say yes, we help them fund it. And they're pretty much responsible for asset management, construction management. They oversee the day-to-day of the deal and actually make it happen, right? So you go out there, you find those people, and if you narrow that down to the ones you want to work with, whatever your criteria is, and that's on a personal basis, right? And then just offer them help somehow, without pay even. If that's boots on the ground, go looking for deals. If that's, hey, I'm happy to be your first source of underwriting, because a lot of sponsors have a ton of deals come across their desk, right? Yeah. And they don't have the opportunity to look at all their deals. So they'll have junior people under them underwrite the deal first. And if it makes it through them, then it gets to the key partner in the sponsorship, right? So just find something that you're good at. It can be marketing. It can be, you have a huge network of accredited investors or sophisticated investors who can help fund the deal. There's any number of ways that these sponsors can use help, because they're typically pretty busy people. They have their hands full with just their portfolio of properties, yeah. Right? So go to them, offer help in exchange for being able to learn and get involved in the business. And that's a really good way that a lot of people have gotten involved in the business. And you're doing something at the same time, and you have somebody behind you who knows what they're just doing and their experience, and they can kind of teach you along the way.
Yeah.
Even if it is that thing that you said, I'm good at this, they likely have just as much, if not more, experience doing that exact same thing.
Yeah, exactly. Okay, cool. Awesome. And then how are you going about, so you're helping with the funding side, so let's talk about that. Yeah. So for your exact position, then how are you going about funding? I mean, there's a lot of people listening who, maybe flipping houses in LA or flipping houses in Austin, Texas. So yeah. What are the best ways that you've found to fund deals? For me, again, it was Bigger Pockets and just getting out there and networking, but is there anything else that you found that worked better than that?
Okay, so for me, I was in a pretty unique situation. A lot of folks who get involved in this space are several years, if not a decade or two older than I am. I started very young in my professional career. So for those who don't know how syndication works, oftentimes these deals are structured in a way that only accredited investors are allowed to invest in these deals, right? And what an accredited investor is somebody who either one has a net worth of $1 million excluding their home, their primary residence, or two has made $200,000 for the past 2 years and expects to make the same this year, or three, $300,000 with a spouse, right? So needless to say, that network can be pretty small depending on where you're at, kind of what family background you came from, what work you're in, blah, 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 yeah. Right? So when I started, I had a pretty small network, right? So I had to really go out there and work pretty hard to grow that network, and I'm still working on growing that network every day. But really where I started was with family and friends, had a couple there, and then I grew that. So I started with just a couple people as my core, and then I grew it primarily from Bigger Pockets and referrals. And then I've also gotten several investor partners from meetups as well.
Yeah.
So for me personally, referrals and Bigger Pockets have been the biggest two sources. But I've seen people grow things through like investor clubs, alumni clubs at their school. Yeah, exactly. Or work or meetups. So yeah. It really just depends on your personal situation. Maybe you have a job where you're a software developer in the Bay Area, and everybody in your office makes $300,000 a year, and that's super easy for you to grow that network, right? Maybe you come from a background where Nobody in your family has a ton of money. You don't make $200,000 a year, and then in that case, you're going to have to work a little bit harder.
Yeah.
But I assure you that it's possible for everybody because I started with a pretty small network, and I've grown it pretty well.
Yeah, yeah, and you're young as well too. So that's the next thing. Like I get asked all the time, Antoine, how'd you go and raise money for your projects? Depending on, you were 22 years old when you raised all this money from Bigger Pockets. How did people even trust you at all?
Yeah.
And it was like, well, like it didn't matter what my age was. I was showing them facts and I was showing them like how knowledgeable, like just like when you sit down with an investor, it doesn't matter what your age is. What can you show me that makes me feel comfortable, that you know what the hell you're doing, that your sponsor knows what the hell they're doing.
Yep.
And like show me past successes and, show me what the current deal is. And if they match up and they look pretty similar, then, people are willing to take a chance no matter what your age is, I found. But it's a lot of people's like mentality. They're like, oh, I'm young, nobody's going to trust me. It's like, well, maybe you haven't learned enough yet and you need to go and learn more.
Yeah, I would add to that, and because you focus on this is a podcast for millennials in real estate, right? So a couple points that I would make and that I've learned over the couple years that I've been doing this. One, partner with somebody who's more experienced than you because that's the best way to get experience, right?
Yep.
Two, show people that you're talking to a strong track record, like you said, past successes. And if you have failures in the past, why did you fail, and how are you going to remediate that moving forward, right? And then three, don't doubt yourself because nobody really cares how young you are. In fact, I've had several people say to me, I actually love the fact that you're this young because I know you have more to prove to yourself. You're not some 55-year-old, 60-year-old person who's a couple years away from retirement and trying to make a couple bucks before they cash out, right? So when you're this young, we've got decades ahead of us until we're at that point. We've got a lot to prove. And when you're in the real estate business, especially when you're raising money and trying to work with other people's money, you mess up a couple times and that's pretty much it. Your reputation is everything. So there's a lot on the line, and I think people who are dealing with this much money and they're looking at dealing tens of thousands of dollars into a deal, that they understand that. They're pretty smart people as well. They've gotten to that point for a reason. And if they can see that you're serious and you know what you're talking about, then they're willing to work with you. And don't start trying to go raise money or do things before you know what you're talking about either, because then you'll just lose your shot at it, right?
Exactly. Yeah, and don't put like for me, like it took me 2 years to even just build up the knowledge base, and then it took me a couple months to actually execute and show proof that all that shit I learned actually made sense in the real world. But then I can sit down with somebody on Bigger Pockets and be like, here's what I've learned, and I can sit down with them and talk to them about everything in my little niche, right? And they're like, holy shit, this guy really knows his niche and, really understands what he's doing, the single family homes, the duplexes, the rental properties in that space. So they're like blown away by that. And then they're like, okay, show me some real proof. Then you show them the numbers and then they're like, oh, wow, okay, yeah, you did complete, if you guys completed 13 deals or whatever, you sit down and show people that, they're like begging for the next deal because they see the success. And you said like to show them the deal that didn't go well. Some of the ones, like, if every deal looks good on paper, then people are going to be like, what? Like, what do you – show me the one that didn't go well. So sometimes
show me the one that wasn't, to the moon.
Yeah,
right?
yeah. And those ones that I would show that weren't to the moon were like the HVAC blew out an extra $5,000 and we still made a 16% return or 15% return. They're like, oh, shit, okay, so the worst case scenario in my head now, instead of that 20% return, was a 12 or a 13, so
which is still pretty solid compared to some other
way better
investment alternatives, right?
yeah exactly. So it alleviates their like frustration or their like the buildup that they've created in their own head, like, oh, what if this blows up, what if this happens, what if construction goes over.
Everybody has their risk concerns, right? And the best you can do is be knowledgeable in your niche, like you said, to show them that you know what you're doing and that your partners know what they're doing if you have partners. And if they don't understand that there's some sort of risk involved in real estate, then maybe real estate's not necessarily right for them. But you did make a good point in that know your niche. You don't have to know everything there is to know about real estate. Honestly, I understand the fundamentals and the basics about a small or single family homes rather, or small multifamilies, but I don't think I know enough to go out and do the deals that you're doing. Just like I'm sure that you wouldn't feel comfortable doing the types of deals that I'm doing. So my point to the listeners is that you don't need to know everything. Just know your niche really well. And you don't need the experience right away either, which is because you can always partner with experienced people. Experience is fantastic on your own, but don't let that hold you back from doing something.
Yeah.
Because it's kind of like a job, right? You get out of college, and they say that you want this and that experience in order to get an entry level job. That's not always going to work out that way. So you got to kind of find ways to tweak what you can do and tweak your internship into that experience, or a past job to relate it to the job that you're applying for. So just deal with what you have, and try to find people who you can work alongside. And then when you want to do deals on your own, you can show those people that you're offering the deal to that, hey, I've done this before. It might not have been on my own, but I've done it with people. I've done successful deals, and I actually have learned a lot from people who've been very good at this.
Yeah. Yeah, and going and offering yourself, like you said, as a free intern to some guy who's a big developer, a big syndicator like that,
Yep.
You're going to learn way more by not getting paid, but now you have this wealth of knowledge that's worth way more than the 50 grand you would have made if he did pay you, right? Or if somebody else paid
absolutely.
you. So, yeah, and I would just go and network. It's all about networking too, because I go to like a bunch of multi-family like networking events over here, and there's sponsors walking around left and right who are doing deals out of state, and they're looking for help. Especially if some kid comes and says, "Hey, I'll work for you for free for a year. Let me prove to you that as long as you show up on time, you work hard, and you pay attention, and you just do what they say, and you continue to learn with them, then it may lead into something else with them. And if not, now you have this whole wealth of knowledge that only took you 12 months to get, but now you can go to anybody, and you're now an asset to anybody's company or anybody's syndication deal, and you can help them, and get paid for it."
Yeah, absolutely. And there's no risk to them either. So if it doesn't work out, they just let you go. But with my sponsors in particular, I know there's several people who did exactly that, and they offered to, hey, I can manage your website, or hey, I can help you put together educational content, or hey, I can underwrite deals before they get to your desk, and now they're working with them full time. So
Yep. Yeah, exactly. All right, awesome. So more about those deals that you guys are doing. What locations or what states are you guys looking at?
Yeah, so we're looking at a lot of locations, actually. We're pretty heavily focused in the Texas MSAs, the Texas major metros, for multifamily. So one of my sponsors has a very large portfolio in Dallas-Fort Worth, and they're looking to expand into another market here in the future. And then another one of my sponsors works in between San Antonio and Austin, right? And then I have another multifamily provider who is in multiple different states. So they're in New Mexico, they're in Texas, they're in Arizona, they're in a lot of these southwest states, right? And then for self-storage and mobile home park, rather, that is very international. So we're not really pinning down to one market, because those types of assets can do well, in a lot of places, right? Yeah. And especially because we operate those in funds, which is a whole nother discussion. But it's a lot of parks or facilities being bought with one raise, right? So they're looking in Florida and South Carolina, they're looking over in Texas, they're looking in California, they're looking in Indiana, Illinois. So it kind of all over the place. There's probably, I would say we've touched maybe 15 states, 16 states probably.
Okay, awesome. So
go ahead.
It sounds like you're working for a couple of different sponsors now. Is that right?
Yep.
So did your mentor introduce you to like a bunch of other people just like him? And then you gave them the same pitch, pretty much, I can come and raise money for those deals that you're doing?
Yep, that's how it happened. A lot of my initial connections were through my mentor, and then just as I've networked and gotten more involved in the business, I've met other folks outside and stuff like that. But a lot of the bulk of my offerings come from my relationships that I built through my mentor. And like you said, a couple different niches, right? A couple different asset classes. So we're in multifamily, self-storage, and mobile home parks.
Yeah.
And bulk in multifamily.
Got it. Okay, cool. And then what's your process for doing your due diligence on those sponsors? So I had a guy on the podcast earlier in the year, very similar situation to you actually. Works full time. Him and his buddies, he lives in Hawaii, so all of his buddies, they all make good money out in Hawaii. They own their own homes, but they have some money to invest. So he kind of created like a fund pretty much to invest in these, or helped these syndicators in Texas or Florida fund their deals. He used to invest with them, but then he brought all his buddies' money, and now they have a pool together, and then they invest together in those syndications. But he was he was very big on like making sure, because he got screwed in the past from investing in a syndicator or a bad sponsor. So what does your process look like, in terms of underwriting and making sure that this sponsor is going to do what they say and going to do what they're showing on paper.
Right. So in terms of the in-depth underwriting, I let them handle the super in-depth stuff, but there are things that I look at. So first of all, I like to see that the sponsors are genuinely good people. I don't want to work with anybody who's out to make a quick buck and they don't really care what they do with other people's money. How have you handled hardships for investors in the past? If somebody comes across a life event where they really need out, are you willing to work with them, or are you pretty much just like, nah, you gave us your money already, you're in the deal? How do they interact with investors? How often are they communicating? Are they forthright? If maybe they have a down month or two, do they straight up tell their investors, or do they try to kind of mask it with some other nonsense numbers that don't mean anything? So that's the number one thing I look at, is for good people who are, they're genuine and they have everybody's best interest in mind. That's number one. And then number two, of course, is that they're conservative in their underwriting. And there's a lot of things to look at, but at a high level, you want to see that they're conservative with their rent growth, because we do a lot of value add stuff. So their growth in, and when I say rent growth, I mean natural rent growth. So how is the market growing?
Yeah.
And then you also want to look at what they're projecting for their rent premiums after renovations. You want that to be conservative. You don't want it to be at the top of the market, right?
Yeah.
And then you also want them to be very conservative with occupancy. I prefer to see occupancy that performs in historically low points of the market. So 2008, 2009, for example, if that market was performing at 84% occupancy, I would like to see an underwriter being conservative enough to where you can give 1 or 2% at 82% occupancy. So in probably the worst market that we've ever seen, you'd return something, right? So so good people, conservative, and then of course I like them to be in markets that I'm interested in as well. So because I'm in Austin, I really like Texas, and San Antonio, Dallas, and Austin are all some of the best markets in the country right now. I don't really want to be somewhere where I don't understand and I'm too far away from it. I don't really believe in that market. Maybe it's just too hot, or I don't think we have enough players or boots on the ground type people in that market. So those three things are the biggest: good people, conservative, and markets I like.
Love it. Great. And what markets do you think are too hot right now?
That's a tough one, right? You're in California, aren't you?
Yeah. Yeah, but shit over here doesn't make any sense. Is there any market? Because so for me, I have a couple, like for the turnkey or just the residential single family side of things. I actually read a report yesterday. It was like Indianapolis, Nashville, Austin for single families were like, and then like I've tried to invest in places like Kansas City before, where it's just like so many, because the prices are so low that there's like so many investors. So like every house that comes up, there's like 40 people and their grandparents are like all making an offer on a house. And it makes it like ridiculous, because then the prices are just drived up to where it doesn't make any sense anymore. So I used to flip houses in Indianapolis. I think I flipped like 3 houses 3 years ago. But then since then I had gotten out of it because the rentals had, gotten way too expensive.
Yeah. Well, I would say that, I'll bring up an interesting point that I think most people would pinpoint a certain market. I think a lot of markets are maybe a little bit too hot right now.
Yeah.
We're at a point, especially in commercial real estate, where people have made so much money doing it. 2016, 2017, people were seeing like 25% IRRs plus on their properties, which is crazy, right? And we're at a point where the prices are just crazy high because all the sellers want to make their dollar off of it because they see how hot the market is. So I would say, honestly, most markets could potentially be overpriced. And that's where it comes in, having relationships, right?
Yep.
Having those broker relationships to get you the off-market type deals, having relationships with sellers to get a discount, having that reputation as closers to where they're willing to take a little bit less money because they know when they accept your offer, things are going to happen. And on top of those relationships and that reputation is just being conservative and being willing and ready to pass 150 deals, 200 deals before you make an offer on one, before you see the right deal. So I mean, I'm of the belief that there's always deals to be had. It's just a matter of how much work you have to do to find them and how fast you can find them. So I know a lot of people get very tied up in, well, is there a downturn? Our market's too hot. I try to be a little bit more optimistic than that and think that, there's always deals to be had as long as you approach it the right way. And it might not be 25% IRR. You might get 12 to 14% IRR. But you know what? That's a heck of a lot better than a lot of other investment vehicles. And if you can still earn a couple percent in a downturn, I'm on board with that.
Got it. Cool. What kind of class properties are you guys looking at? A, B, C? What kind
We're
of, for the
typically
multifamily?
So like I said earlier, we're doing value add, and for those listening who's not sure what value add is, it's right there in the name, in that you're looking for some way to come in and add value or increase NOI, because NOI with commercial real estate is directly correlated with the price of the property, right? So you're looking in any way you can come in and add value so you can increase NOI and increase the sale price. And there's two main ways to add value, and that's increase rents or increase revenue that you're bringing in depending on the asset class, or decrease operational expenses, right? And because those are our two main goals and what we're looking to do, we're looking at typically anywhere from B minus to B plus. Every once in a while we'll look at A minus, and that's because we want some room up here to grow. We don't want to be at the top of the market, and we want, the sweet point is kind of maybe for multifamily, you said, for example, is maybe a 1980s-ish property where there's not a whole lot of deferred maintenance, so we're not dumping money into something that's not making us any money, but the interiors are pretty dated. So we can go in, spend a couple $1,000s on each unit, and increase those rents by 120, 150, 180 bucks per unit, whatever, and increase our NOI, increase the value. So because of that, because that's our strategy, it makes sense that we're looking at in the B class. And a lot of value add folks will look at C, but we're typically not operating in that space. We're more in the B. It's a little bit more working class, kind of higher residency, and there's a little bit less problems involved.
Got it. Okay, cool. Yeah, for me, for the residential side, I'm all C class, but then as soon as I get to the multifamily side, I go right to the B class. Yeah. Because there is, like, if you have one bad apple in the C class, then it ruins the whole damn building, and it's like a really heavy management burden. But if you stay with the B class, less chances of having those people. You can have, a little bit more of a white collar kind of tenant moving in to the. It might be, white and blue collar mixture, but less chances of having the high crime or having certain people living, like drug dealers or anything like that, living in your, one of your units too.
Yeah, absolutely. I think it depends on the person too. Some people, you'll talk to them and they say they've had the most horrendous experiences with C properties. You'll talk to the next person and they've only done Ds and never had a bad experience. So I think it depends on the person and the market that you're operating in. But yeah, we like to pretty much stay in B. And another reason for that too is if you look at a downturn, right? If we do hit a downturn in the market, and you think A-class properties where they're at the very top, and you think residents are going to start dropping off and start spending a little bit less money on their rent, those A-class residents are going to fall down into the B, and the A-class is going to suffer a lot more than any asset classes under them, because there's nobody feeding into them who's dropping off from a higher price. So
exactly. Yeah, and that's why I love the C class too, because even then, if you're B class unit, my C class properties rent out for $700 for a single family home, $800 for a single family home. So even two people who are working some minimum wage job at a coffee shop can still afford my rent. And that'll be like, if they lost their job working at some other company, like a FedEx or something, and they need to go back to just working an hourly job, they could still afford to live in one of my properties too. So
yeah, absolutely, I couldn't agree more.
Yeah, so we actually see that the occupancy goes up. The rents stay exactly the same, but even like through 2008, for example, in my neighborhoods, it was like occupancy had spikes. So it went from 90% to 99% occupancy through that time. So yeah. All right, awesome, cool. Well, what's the best way for people to get in touch with you if they have more questions about you, about what you do? And thanks for coming on the show.
Oh, absolutely. Yeah, thanks for having me. So best way to get in touch with me is probably through my website, and that's bishopinvestinggroup.com. My email's on there, my phone number's on there, but you can also email me directly at mike@bishopinvestinggroup.com. Pretty active on there. I keep an eye on it, and I'm also on Bigger Pockets too if you want to connect. There's probably a lot of Michael Bishops out there, but if you want to look for Michael Bishop and look for the guy who looks like me, I'm on there often too. Like I said, I'm always on there networking. So those are two great ways to reach me. All my contact information is on my website. So
awesome. Cool, Michael. Thanks so much.
Yeah, absolutely. Have a good one.
Have a good one.